just a quick flyby on where the market is and where it's been. We've had quite an interesting last 30 days, I would say. We've had an up market, which is great. 21% up year to date on the NASDAQ is phenomenal. We expand to the 1 year, up 32%. I'll take it. I like the green on the screen. That is great. But if we zoom in for the last month, we've had some adversity. We've had some volatility, and that's normal. We should have some volatility. We should have pullbacks from time to time to bring down prices, especially when they're overheated. The principal industries that got pulled back a bit were semiconductors and technology, which is good. We can't have those stocks going up forever. But what has been amazing is how fast, especially the NASDAQ and the S&P, have recovered those losses. The NASDAQ officially went into correction territory, going down more than 10%. And it's really gained all that back really fast, which has been amazing. Now, it hasn't gained it all back in the same industries, which is good. Begin to rotate into other sectors, and I'll cover that in a bit. But that's what's been happening for the last couple of years. If you look at really beginning of 23 up until now, we're up 71% on the NASDAQ. That is a beautiful ride. Of course, that was following a pretty brutal year in 2022. So let us not forget that not every year is going to be like this year or last year. In 2022, the NASDAQ was down 32%. So we are coming off of one bad year in 22 with what is looking to be 2 good years. So that's all fine and dandy with me. Looking at sectors, what's been moving with regards to sectors today, it looks like the best sector was materials, which is interesting because I'm going to talk about the economy really quick. Materials were moving, which kind of surprises me because there is threat of a recession being on the horizon. You keep hearing about the Federal Reserve is going to bring down rates, and that is likely going to happen as soon as September would be the first rate cut. And then they're expecting that they're going to get on this pattern of reducing interest rates for some time. And that's usually pretty much a signal that we're going to go into a recession of some sort. So I'm surprised the materials rallied today because if you're going into recession, material companies tend to sell off. Consumer discretionary did okay, and so forth. But over the last month, the sector that's done really well, utilities, healthcare, consumer staples, real estate. So these are the industries that are having a good month. But over the last year, really, it's been the tech space has really won the battle. Technology, especially semiconductor companies, have really done well. So that's where the money's at. I don't know if they're going to keep rallying. I think they're priced fairly expensively, but we'll see what happens. All right, so that happened. Now that's high level market. Let's talk about some individual stocks now. And I'm going to start with Zoom. So I've been an investor in Zoom for some time, just to put that out there. And everything that I talk about is just one investor sharing his analysis with other investors. It is not financial advice. I'm not recommending you buy, hold, or sell Zoom or any stock that I talk about. But let's talk about Zoom. So Zoom, I think everybody knows what it is, right? You can do video conferencing over the Zoom platform. They just really exploded. Back in the day when COVID hit, their stock just went through the roof because the usage of Zoom went through the roof. We were hit with a pandemic, and everybody had to go home and work, go to school, and so forth. And their stock just rallied 738%, which was incredible. What a rise. And the usage just went through the roof. Now, when you look at from the peak to the lowest point, which is probably around now, the stock sold off 89%. Yet the Zoom business is pretty damn strong. It generates a lot of free cash flow, which I'll show in a bit. It just does a lot of things. So I've continued to evaluate the company and try to invest at the right time. So far, the investment hasn't been great, but let's take a closer look. All right. So, and I apologize if I don't keep up with the chat, but I'm going to keep rolling and try to catch up at some point. All right, let's do this. All right. So Zoom announced their earnings today, and overall their revenue was fairly flat, right? They grew 2% top line, which isn't great, by the way. We've had companies like Meta came out with good growth, like 20%. They're massive. You got Google Alphabet growing double digits. You've got Microsoft growing double digits. Zoom is far smaller. So for them to just grow at 2% is somewhat of a disappointment to me. I think they ought to be growing at 10% plus because they're smaller. But I think that's a signal that they're kind of a one-trick pony where they're just a one product company where they do video conferencing. They do it very well. They're probably the market leader. Users like it the best. Okay, I get that. But it's showing up in their inability to grow. They have one product. They've sold into the market that they really target. And maybe they've gotten all the customers that they're going to get. That might be a concern for me. Their enterprise revenue, which is bigger businesses that have lots of users, that went up 3.5%. Again, not a big growth number. I'm not really impressed with that. the one item of good news is their cash flow is increasing. So the amount of cash flow that they're producing out of their business is increasing. Very good. Another signal of goodness is they're buying back shares. So they're taking a lot of that free cash and buying back shares, which is the recipe that Apple's used to really prop up their stock price. They were coached by Warren Buffett, and they've done that really well. So those things look good, the last two things, but I'm a believer that top line revenue really tells you how strong a business is. If a business is growing their top line revenue, they're getting more customers, their product's good, so more customers like it. There's just a lot of good health to it, that when a growing business tells you that that's a strong business. And I'm beginning to feel that Zoom is really plateauing and may have a tough time going forward, especially if, one of the other bigger competitors really aims to take some of their market share away. As we look at the other highlights, they did have their outlook, and it's really to be flat. So they're not expecting to grow very much. So from a growth perspective, it was somewhat of a disappointment. They did generate more cash. They have a lot of cash on the balance sheet. They have over $7 billion of cash on the balance sheet. The thing about Zoom that you got to keep an eye on is their market cap is $18 billion, and they have $7 billion of cash on the balance sheet. They don't have any debt. So it's almost like the real market cap is about 11 billion because you have, so much cash on the balance sheet. So that's one thing I keep an eye on. You're getting a company really at a very good sales to market cap ratio. The PE ratio at 22 is fairly decent for a tech software company, and their forward PE is really low. The analysts are saying hold, but it is discounted in their opinion. Looks like 20 analysts, which is quite a few analysts, cover the stock, and their average price target puts this stock as being discounted by 25%. They base most of their, valuation of the stock based on their earnings per share, which is pretty solid at $5.20 a share. It's not going to grow much. So this is my biggest concern. No growth in top line, no growth in earnings. So that's kind of a double negative for me. So what do I think Zoom is worth? So I've built my own model to value companies, and here it is. And the valuation model consists of two things for me. I look at their free cash flow, and then I discount that free cash flow based on a discount rate that I think applies. And secondly, I look at earnings per share and value the company based on earnings per share. And then I blend those two valuation methods. So first, let's go over free cash flow. So I've taken the first half of free cash flow from their financial statements that we just saw, and I am going to double that since it's for the first half, and then grow it by about 5%. And that's the growth rate I have on their free cash flow. They have been growing faster than that, which is impressive. Let me catch up to my screen here. And so that's the starting point for year one. Now, this is a free cash flow forecast. In the first 4 years, I'm going to grow cash flows by 5%. And then terminal value, all cash flows after year 4 are going to grow at 4%. I think Zoom will achieve those. They've been growing their cash flow much faster than that, but I want to be conservative. Now, that's the cash that I expect in the future. What am I going to discount it by? I'm going to discount it by 10%, which is a high discount rate for a riskier company. I think Zoom's a little risky because they're a one-trick pony. They have to compete against Microsoft, which has a pretty competitive product. Even Google has a pretty good product. And I think that although Zoom does a great job of video conferencing, I have to give them a higher discount rate. And that discount rate I use to get to a net present value, an intrinsic value of all those cash flows. And the value I have on all those cash flows is $31.1 billion. And I add the cash on the balance sheet, which is in addition to the value of the company. They have no debt to deduct. And really, the value of those cash flows, the value of that cash on the balance sheet amounts to $38.6 billion. The current market cap is only $19.8 billion. So it's really discounted if you look at the cash flows that Zoom is generating versus where the market is pricing this company. Earnings per share yield a very similar result where the earnings per share is $5.20. PE, just using an 18. This is a tech company, high margins, very good free cash flow rate. And just growing it by 3%, which is pretty much no growth, you still get a discounted share price of 54%. So blended, Zoom is just a highly discounted stock. The one thing that Zoom has dealt with is just the market does not like their stock. I think that once we had the stock go from this height down to these levels, just the stock has not recovered. Other stocks have done better. And I'll show you a different example where a company did have its stock go down significantly, but it has really risen. And of course, that is going to be Meta. So if we look at Meta, I mean, not everybody made it through the last 5 years without the stock being punished. And Meta was really punished not too long ago, went down 76%. But Meta got off the mat and really started to do things right. And their stock price is up 489% from that low point. But Zoom has not done that. Their stock prices continue to go down. And, I don't know if it's their fault. They just they're kind of a singular product company. And I think the market is really concerned with that. I'm beginning to get concerned with that because I was not overly concerned that they were a single product. Hey, if they can dominate that space really well for a while, I think they're going to be fine. But if they're not going to grow and they're a single product company, that does become uncomfortable. So from a desirability standpoint, we see that the Zoom stock price, if you look at cash flows, you look at earnings per share, it's a discounted stock. But is this company really desirable? What's a desirable company? Well, desirable companies have very strong moats, barriers of entry. They don't have a lot of competitors. They're almost like a monopoly. So companies like Microsoft, companies like Google with their search business, Amazon with their e-commerce business, they're so good they have few competitors, few rivals, and they can really grow in a very large or expanding addressable market. They can generate a lot of profits and a lot of free cash. Now, if you look at the companies that are the most valuable companies, they tend to have really strong moats and generate a lot of free cash. So I want to find companies in that green zone. I want to stay away from companies in red zones, which is companies with too much competitions. These are like restaurants or retail, right? Retail is tough. Retail is everywhere and it's getting punished by e-commerce. So I don't want to buy companies or industry companies that are in the red. And in the gray are good companies, but they don't have overly strong competitive barriers. They're just good businesses. And I think that Zoom is more in the gray with a little bit of green. I think users really do like the Zoom platform. They prefer it more than the Microsoft, platform or even the Google Meets platform, but they're not completely in the green. They have some advantages of having preferences from the user base, but they really are a company that has some desirability, but not exclusive desirability. They don't have complete competitive moats. It's beginning to show up because they're not growing. And it might be that users are just getting really tired of video conferencing. So we will see. We will see how that plays out. All right. So that is Zoom. I own the stock. I've been holding the stock. I haven't been buying more shares. And what am I going to do with this stock? Well, fundamentally, I like discounted businesses, but this business, after market, it's up what looks to be 2.56% now, which is nice to see a small rise. But if they don't get on a nice upward trajectory on, seeing their stock price really go up in value, I just don't know that I want to keep this in my portfolio. I really want to find companies. A good example would be like Uber. Uber has really been growing, expanding their valuation and really heading and getting a lot of momentum in the market. And, I bought Uber a while back, have held the stock for some time, and I'm sitting on a nice gain. That stock's really performed well. Zoom has just really been stuck in the mud. And I'm not sure that I just want to sit around waiting for it. My investment in Zoom has not been very productive. For a while, I've just been bumping along the bottom here. And, if anything, it's a distraction. At some point, I may have to sell the stock. For now, I'm just going to hold it, think about it, and see what I want to do with this stock. All right, so that is Zoom. We'll see how it trades tomorrow. We'll see where the market trades tomorrow. All right, this is my first time working on the Stonks platform, so everybody bear with me for a second. And let me go. Let's see here. See if I have any comments. If you guys want to look at a particular stock, let me know, and I can take a look at that stock. So let's see here. All right, doesn't look like there's any requests there, so let me keep rolling. All right, so the next company I wanted to take a look at is Chegg. So Chegg is a company that has been sold off, man, big time. It's almost a little bit of what Zoom has been dealing with. If you look at the Chegg business, if you're not familiar with it, it's a company that helps students with, think of tutoring, knowledge so that they can really learn these tough subjects that the kids have to learn these days in high school and in college. And the stock, during COVID, when everybody had to study at home, the stock really just went really high, 182% gains if you look at from when COVID started till its height. But once, it was determined that, hey, we're not going to have that demand forever, the stock's really sold off. 98%, it's sold off. You can buy the stock at 2 cents on the dollar. Amazing. And the stock, I think it's an opportunity because if you look at the free cash flows this company is producing, And you look at the fact that at some point they're going to start growing. Their user losses are not severe. They're just kind of stabilizing after the COVID rise because they had so many users during COVID. Having said that, more recently, you can see that the stock's done a little bit of rising, 16%. It's still a pretty tough investment at $2.29. But it's good that today they had a good day, up 8.5%. I have this stock as being discounted, and I've been nibbling on it because I just think that at some point they're going to start growing their business. If you look at the Chegg business, we look at their top line revenue. For the last couple of years, they've been in the red, and that's because during COVID, holy smokes, man, they grew their business 56.8%, and they had a lot of new users and so forth. They continue to grow through 2021, but then they kind of hit a wall. They started to plateau, and they've seen losses of both users and revenues. But I think that's going to stabilize, and at some point, you're going to see some of these quarters turn green. And I think once that happens, and you have a growing business in what is a pretty decent market with very good margins, they would probably rally. So that's a stock that I've been nibbling on and maybe buying some call options on it, really multiplying the effect if they were to rise. So I'm going to keep an eye on Chegg. One thing that they've been dealing with is the perception that AI is just going to completely replace them. And I don't argue that AI is going to do a lot, but as I look at what Chegg provides, AI can't do that today. And I don't know how soon AI is going to be able to do it, which is a little bit of, person-to-person tutoring and value add on how to learn a particular subject, a particular science. It's very difficult. To this point, I've got a couple of anecdotal pieces of information. I have a son in college, and he uses a Chegg platform, and he doesn't want to give up his subscription because he thinks it's very valuable. And that ChatGPT or Gemini from Google, they give you a couple elementary responses, but the real information is in platforms like Chegg. So he gave me that testimonial, as well as on my channel. I've had comments from other people that have graduated college recently. They also said that Chegg is valuable, that it's going to continue to go because it's a platform that they found to be a necessity when they were dealing with really difficult topics. So I thought it was interesting to see Chegg rally today. We'll see if it continues to rally. I've been nibbling at that stock, and we'll go from there. Looks like Lextron wants to look at Intel. I put that on my list. Thanks for the suggestion. And let me catch up on comments real quick. And I'm seeing, and FYI, if I miss your message, I apologize. All right, let me check Discord real quick. One second. All right, so it looks like I'm going to be, I guess, managing the raffle, and let me try to figure out how to do that. It looks like let me take a look here. So I am not quite sure how to do that. So let me try to get some help in doing that. All right, bear with me, people. Just 1 second. 1 second. All right, so let me try to go there. Stocks dashboard. Okay, so we're here. Okay, I see it now. All right, so let's go ahead and let me try to spin the wheel, see what happens. All right, I just spun the wheel, and everybody want to put in, I guess your. All right, here we go. I'll leave it open for a few minutes. All right, so let's do this. All right, congratulations, Angry Buddha. You're in the money. Looks like you won $100. Congratulations. All right, cool. All right, let's keep rolling. Well, that was fun. That was my first time. Hopefully it was fun for everybody. All right, so let's keep rolling. So we're still talking about Chegg, and I continue to think that, if you look at the upside potential of Chegg, it might be worth for me, nibbling on shares. And And you know what I didn't do is I didn't share the spinning of the wheel. So I'll make sure to do that next time. All right, guys. And we'll go. Let me put that over here. All right, so you guys can see it now. But let me go ahead and spin it again so you guys can see it. We'll spin it again. All right, Jason. Is that Jason that put this together? We'll see. All right, congratulations, Jason. Thanks for attending. All right, cool. So we're looks like we're giving out some money, and now we're going to talk about some stocks again. All right, so all right, cool. Let's talk about Intel. Somebody want to talk about Intel. So Intel, I mean, they had a brutal earnings, man. It was just terrible. They had their earnings call right around this date, and they just dropped. They've dropped 38% since then. And I think Intel could have done a much better job of just telegraphing that, hey, their earnings are not going to be very good, that they were going to have a couple pieces of really, really bad news. And then investors could have felt like the blow coming, and it would have been better. But in their case, it was they just surprised everybody during their earnings, and the stock has been punished, to say the least. You see the stocks come down just substantially. And so as I look at Intel, this historically is like one of the best, semiconductor stories in the history of the technology sector. They were the company that put so many chips in PCs, and the world is really running on Intel if you look at PCs. But for the last 5 years, they haven't done well at all, which has been really frustrating, I'm sure, for shareholders. If you look at their stock price, it's just been going down and down. It's really showed promise, a little bit more recently. It was up 95% if you invested in late 22 and up until 23. But then after that, it's really just crashed and burned. So it's just been a really sad state of affairs. Now, I'm staying out of Intel. I just think it's a mess. The business, I think they need about a year to get it all figured out. And then maybe Intel might be investable for me. But for now, if they can't telegraph that they're going to have really bad earnings, I just don't really trust their next earnings report, the next couple of them. If they can have a solid 1 year performance, maybe I would be interested in Intel. But for now, I'm just staying away from them because it's just been a brutal, brutal state of affairs there. All right, so I'm going to keep spinning the wheel. I think I'm supposed to do that. So let's spin the wheel again and see who gets. Oh, okay. I think so. Forever. Let's see who's going to get third place. And this is my first time doing this, everybody. So I apologize that I'm not getting this right. But Boss Haas looks like he won some money. Congratulations. Let's spin it for fourth place. Now I get it. I spun it for the first place winner. Now, and I spun it for the second place winner. Looks like Bontos. I'm not even going to try that. Congratulations, man. All right, let's go for fifth place. Elvis, 1982. Congratulations, man. 574. Then for sixth place, India. Congratulations. You're in the money, in the green. And then triple question mark, a person of mystery. Congratulations. Not even going to try that one either. Congratulations. And for eighth place, it is going to, it's me. Congratulations. All right. So we went through the raffle, I think, and thanks for bearing with me, everybody. And just to recap, Angry Buddha took first place, Jason took second place, Boss Haas third place, and then everybody else that's in the money is listed. Congratulations, everybody. And let me just check in with Jason really quick. All right, so we talked about Intel. Let me check in with the comments and see if there's another stock. And it looks like okay, just watching. Any other stocks you guys want to talk about? I've got a list of them, but I'd like to talk about stocks that somebody else would like to nominate here. Let me take a look. All right. We got through. All right, cool. All right, so we talked about, okay, J&J, UPS. All right. Some very well-known names. Let's talk about those. Any others? ASTS. Not familiar with that one. And cool. Johnson & Johnson, very well-known company that had some legal troubles not too long ago where they had baby talc, a big class action lawsuit. I think they've gotten that one put to rest, which is good for the company. Now, this is in a space that I think is going to do quite well. Healthcare, I think, going forward is going to do well for a couple of reasons. Is that it hasn't done great for like a year or two. So I think there's some pent-up upside that can happen. I think the valuations are really good. PEs are good. And Johnson & Johnson, as you could tell, over the last 5 years, you've only gotten 22.7%. That's not very good. Over the last year, it's down 3%. So this is an example of like where healthcare is at. But these companies really drive a lot of free cash flow. In this case here, this is a $388 billion company. Revenue is $86 billion. But when you look at their cash flow, these guys produce very high cash flow. This trailing 12 months is almost $20 billion of free cash flow. That's very good cash. And when I look at a company like this, if I like the company, I see that they're, growing their revenues. I tend to take that cash flow and just back of the napkin and multiply it times 20. If I see they're growing, good company, good balance sheet. And if I multiply that 20 times 20, I get to about 400. So the valuation is pretty much fairly priced. This company is fairly priced. They pay a dividend of 3%. And, analysts say that, hey, it's close to fairly priced, but it's a buy rating because it's historically been a really good company, really solid balance sheet. They have a very good credit rating. If you ever look at their bonds, I own one of their bonds. So that's why I know they have very good credit rating, but they produce really high free cash flow. They have those lawsuits behind them, which is very good. They're growing. They're a big company. So growth for them is a little more difficult. Their balance sheet should be good because they tend to have very good, debt level compared to their EBITDA, well below 3 times EBITDA. So that is looking good. Analysts think that J&J is a buy. It's not a screaming discount, and they expect that earnings are going to grow nicely. Single digit, but it's going to grow over the next 5 years, which is good. And earnings per share is nice and high at 10.81. So overall, it's a solid company. J&J is, I think, kind of a good safe stock that investors will buy. I don't own J&J. I don't think there's enough upside in Johnson & Johnson for me to be a player. I do like healthcare. To kind of go real quick through some of the healthcare companies that I like and currently have invested in. So I have a mix of, here's my healthcare stocks that I own. So I have a mixture of big and small. Catalyst Pharma is, you can call them a small cap, and they have terrific growth. And I still think they're nicely discounted. I've done well with the stock. I've invested about 20,000 in my stocks, worth about 30. United Therapeutics is really exciting, faster growth, really interesting pharmaceutical company, and they are growing nicely. I think they're nicely discounted. I've made good money on United Therapeutics, and I think there's more to go. For a big pharma, I think Pfizer provides really good value to the investor. They are rebounding. They had some rough years where during COVID, they sold vaccines, so their numbers were just screaming through the roof. But after they couldn't sell vaccines, the market, began to correct that price of the stock. So the stock was really sold off, and I think it really is going to be a nice rebound stock, and really like the stock. I have it discounted. Haven't made a ton of money on that yet, but I think it's going to change. I'm an investor in CVS. I think they produce really high free cash flow, and I'm also an investor in a healthcare payer, an insurance company that pays for healthcare and that people buy policies with, or companies buy policies for their employees. So I'm a believer in healthcare. J&J fits into this space. I just don't invest in J&J because I feel like I'm getting a better opportunity in investing in other companies. But I like the idea of investing in healthcare because I think it's going to have a very good next 12 to 24 months. If we get hit with a recession, healthcare is recession proof. It's not like, people go to the doctor during a recession and the doctor says, you got to take this medicine. Oh, sorry, doctor, it's a recession. I'm not going to buy medicine for this illness I have. No, they're going to take that medicine. They're going to spend the money that they need to take care of themselves. That's why healthcare is resilient during recessions. So I like thinking about Johnson & Johnson as well as other healthcare companies at this time when I think we are going to have a recession. If the Fed is beginning to reduce interest rates, they're, pretty much giving us signals that they're seeing that the employment data they're seeing, we're having job losses, but we're going to have a recession. I don't think it's going to be ugly and last a long time, but it's still going to be a recession. So we'll see what happens. All right. We talked about J&J. Let's talk about UPS. And UPS, I like looking at UPS for a couple of reasons. One, this is a very good company. Historically, it's just been a principal component within our economy of delivering packages. Yours truly, when I was in college, I worked one winter, during the Christmas peak at UPS, and man, we worked so hard, and there was an awesome experience for me, and it's been great. Now they have a market cap of $109 billion. Now during COVID, when everybody's getting all kinds of packages delivered, you can see that their stock just really went up nicely. But ever since COVID, this picture has changed. The stock has not been doing all that great. And it tells me a couple of things, right? So if you look at from the high to now, UPS is down 43% over the last couple of years. And when you see a stock like UPS really lose volume, it tells you something about the economy. The consumer's not buying as much stuff online. They're not as many transactions. So that's another piece of evidence that I think we're going into a recession of some sort. And UPS is not digging themselves out of this hole, I'm going to call it, very quickly. If you look at their revenue, it's been going down. So again, the health of a business, I believe, one of the primary metrics that I look at is revenue growth. If revenue is growing, that means the business is strong. The products are desirable. They're getting more customers. The customers they have are buying more services or products. And when you see revenue decrease, especially for a legendary company like this, is what's the problem? Lower volumes. People aren't, using UPS as often. Another potential risk is, Amazon has their own delivery network now. So is Amazon pretty much saying, hey, we don't need you, UPS? And are other companies going to follow the model that Amazon has? I don't know, but there are, some clouds over this company right now. The good news is the most recent, quarter only went down 1% in revenue. So it looks like they're not losing as much revenue in the most recent quarter. I keep an eye on this. Now, I like UPS because I think they're one of the, historically an important company in our economy, and it's a good company, but I just don't see how I can make a ton of money on this stock. They pay a nice dividend, but I'm not captivated by dividends only. I'd rather see a stock double in value in 3 years than you pay me a nice dividend. I mean, who wouldn't want that, right? I'd rather see my stock price and value of my investment go up much, much, much faster. And I don't know that UPS can deliver great returns. I don't think they're going to grow that fast. They have never been a super high growth company. They were dealing with a pandemic. We were dealing with a pandemic, and they grew at 14%. But if you see before COVID, they were only growing at 3%. After COVID, 3%. Well, a company like that, maybe they give a good return. Maybe you make 5-10% a year in appreciation. Well, I'm not looking for that. I'm looking for companies that are going to deliver substantial returns, like Meta, Uber, they go up 25-35% per year. So UPS is a good company. It's a good stock, good paying dividend, but it doesn't have a place in my portfolio. I need to see greater appreciation long-term. Again, just to remind you, I'm just an investor sharing one opinion. I'm not providing any financial advice. I'm not saying, buy or sell UPS. Make your own decisions. And, frankly, it's just one opinion. The things I say may prove to be wrong, but we'll see. Time will always tell. All right. So we talked about UPS. Now let's talk about ASTS. Okay. This one I did take a look at on another live stream. Look at these guys. They're just going crazy. Oh man. What a fun stock to look at. Now, these guys here, they are going to launch satellites into space, and those satellites are going to provide, a broadband internet for subscribers. And if you were smart enough, fortunate enough, or lucky enough to have bought this stock, you're sitting on 15x your money in roughly 3 months. So congratulations, everybody who bought stock in this company. I salute you. Very good job. Now, for all the rest of us, let's take a look at the stock. Now, one thing I would say is it was announced that they're going to launch these satellites, which is great. Right now, they're a zero revenue company. So, all right. I don't know much about this space. I will have one comment later about a different company, but let's kind of just look at this company. So it's almost zero revenue. Okay. Now they are burning a lot of cash. Their net income is all negative. Okay. And then their free cash flow is actually negative. Another way of saying it is they are consuming $282 million per year that are just vaporizing. And when I look at their balance sheet, they have $285 million in cash, which almost is 1 year of burning cash. So they have like 1 year to operate. And I don't think they have debt, but let me take a look. No, they do have debt. So they do have some debt. So this is a type of business that obviously it's super exciting and it's pretty fun to watch it. That's great. But unless I know a lot about this business and I feel really comfortable that they're going to execute this quite well, then it would enter my investing, picture, because a lot of things could go wrong. There was another company by the name of Viasat that I was following. This is a number of years ago. They launched satellites into space. They got them into the orbit. Then they pushed a button to turn the darn thing on, and it didn't work. And it was a complete failure, and they lost all their money in that investment. Not saying that's going to happen with this company. I'm just saying when you're launching stuff into space, it most likely will work, but there is some risk that it may not work. And how are they going to get customers, and how soon will they get the revenue? There's just a lot of things there. It was a tiny market cap company, but now it's 5.5 billion. Don't know if it's a good investment at this point. It's not the right investment for me. I'm more of, let me see some fundamentals. Let me see some cash flows. Let me see some revenue growth. And these guys don't fit any of that kind of profile for me. I took you through my Zoom example. I look at financials. I look at fundamentals. And then I make a decision. Hey, do I want to own that business? These guys are interesting. Most definitely the stock has been super interesting. But, for all the people that were fortunate to buy it when the buying was great, congratulations. But I'll just consistently make, a good return on my investments. And this is not the right type of investment for me. But good luck to anybody that wants to invest in AST Space Mobile. So thanks for asking about that. Man, we got some more requests. Let's take a look at this Path. Let's take a look at Path. I haven't looked at Path in a while, and it is an interesting company. CVNA, and I think, is that Carvana? And then THX. All right, THX. So let's make sure I've caught everybody. Yep, we got everything. All right. So let's start with Path. So Path, I believe, I'm going to call them like a software company. And I believe they kind of have a technology that enables businesses to, let me make sure I have the right company, because sometimes I think, yeah, that's the company I looked at and my memory fails me, man. Yeah. So end-to-end automation platform offers range of robotics processes, automations. So you're basically coding, and then you have machine learning, and kind of repetitive tasks could be done in an automated way. So they're finding use cases for companies to use their software application, their software infrastructure, to then be able to automate some of the, office operations, warehouse operations, manufacturing operations, those types of things. So it is an interesting proposition. When they came out, this company came out and they were on a tear. Holy smokes. They IPO'd, and man, and they were priced at like $70 a share. And then holy smokes, they really got sold off. They got sold off. 86% of their value vaporized. Ouch. Now, more recently, let's take a look at last year. They've had an up and down year. For the past year, they're down 18%. More recently, they're down big. Holy smokes, 54%. What the heck's going on with Path? So let's take a look at their fundamentals real quick. So the company is a $7 billion market cap company. So I'm going to put them in the small cap category. I know small caps used to be like 500 million in revenue, but for Pete's sake, we got 3 companies over $3 trillion in valuation. We got multiple companies above 2 trillion. We got companies above $1 trillion. So now I consider companies that are like below $20 billion to be small caps. And I don't know where the line's going to be going forward, but man, valuations have gone up, huh? So this one's like a small cap, and it's about a $1.35 billion revenue company. They're not profitable yet. Let's see if they produce some free cash flows. Forward P is 35. Not too bad if they're growing a lot. Analysts are saying, hey, hold, but they are discounted. It's probably that big price, reduction that they've seen recently. Now the growth is looking pretty good. 22% growth isn't too bad. Now I would say it's on a $1 billion revenue company, which isn't all that much. Again, if you look at Meta, those guys are gigantic and they grew about this rate. So it's really impressive that Meta pulled that off. These guys are a $1.3 billion company growing at 22%, which is very good. Very good. Now they're not profitable yet. So their earnings per share is going to be a little bit of a forecast, but let's look at their cash flow. If they cash flow, I'd be kind of in the game here. Now we got $325 million of free cash. I like that. $325 million. And look at this growth rate. They went from, hey, we're a new company and we are making a little cash flow, losing a little cash flow, losing a little cash flow. Now we're making cash flow. And the reason for it is these technology companies, they create the intellectual property, the software. They create it once, and whether they sell it to one customer or 1 million customers, really the incremental cost of each additional customer is not really high. So they make lots of cash. I like businesses like that. They're in that green quadrant I showed earlier. All right, so 325. So I use my rule of thumb, 325 times 20 would gives me about 7 billion. Boom, that's where the company's valued. So this company is going to be about fairly valued. Now, UiPath has a pretty neat software. Now, why is the market selling them off so much? What's going on? I'd have to study the news and understand what the heck's going on and understand how can they crank up this growth? Can they grow to 40%, 50%? Because they're still quite small. So there's a lot of questions open out there, but I would say that these guys would value around their current stock price. And if I study them, and technology is one of the industries or sectors that I like, software companies, I own multiple, and can kind of get a good handle on whether it's a good business or a bad business. So I would do more homework on Path. I don't think it's an obvious buy, but I think it's an interesting company worth a little more investigation. I couldn't tell you if I would be a buyer or seller or if I would pass on this stock. Right now, all I could say is that I'd probably dig a little deeper on Path. So thanks for asking about Path. All right, let's talk about Carvana. Man, these guys, I love stories like these guys. You know why? Because these guys were left for dead, just completely. You know what? These guys are going to be bankrupt. These guys are not going to exist. The market was like, hey, you know what, Carvana? You will not exist anymore. We're going to sell you off by 98.6%. Holy smokes, man. That's like a penny and a half on the dollar. You do not have any value, Carvana. And Carvana said, hey, you know what? Pardon the language, but F you, stock market. We're going to rise. We're going to go up 3,000%. Beautiful. I love stories like this because this business, the employees, the founder, everybody picked themselves up from the bootstraps and made this business work. Congratulations, Carvana. Congratulations to any stockholder who believed in this company when it was, the believing was tough and made all that money. Congratulations. It wasn't me, but I hope that a bunch of people on this live stream were people that owned Carvana because you would have made some big money. All right, let's take a look at the fundamentals because we know the story is good. Let's take a look at the details. So now they're a $19 billion company. That's a pretty good size. They're still kind of small, but these guys are trying to change the game when it comes to retail used car sales. I mean, who doesn't dislike used car salesmen? There's a whole analogy for used car salesmen. We hate used car salesmen. So these guys are trying to change, or I should say, give consumers an alternative where, hey, you can go buy a car from people that are going to treat you decently, give you really a good information to make a good decision on a car, which is a major purchase for people. So I love the idea. I think it's a good business. Now, it's not my favorite business. I think automotive is tough to make money. The margins are not really good. And these guys got caught. The reason their stock price was so low is they buy used cars, recondition them, and then sell them. And they got caught buying cars that lost so much darn value. They bought a car for $20,000 and pretty soon it was worth $15,000. So they were losing value on their inventory very quickly. Now, that's an example of why I don't like auto. I don't like automobile retailers. I don't like manufacturers of automobiles, including Tesla, is that there's far better sectors and industries where they make lots of money, like Eli Lilly. They invented that, weight loss drug. They invent it once and then they sell it to 1 billion people and make lots of money. And then their market cap goes up to $1 trillion. That's the kind of business I'm looking for. But nonetheless, let's look at Carvana, which has really, picked itself up from the mat and really proved that they're going to be around for a while. So their PE is really high, 80. And then their forward PE is 170. So that's not really attractive. I don't know if it's attractive to you. Now, their revenue, right? The revenue it really did collapse during COVID where there was shortages of cars and used car prices were going through the roof. They were making They were making lots of money. They doubled their business. But then all of a sudden the market turned on them and they started to lose revenue and started to lose a lot of money. If you look at their losses, look at that. They were just losing a lot of money for a couple of years, but now they're back on their feet. Cash flow, I don't think they produce a lot of cash flow. I looked at Carvana recently, $738 million, and their market cap is 19.4 billion. Now, if I divide 700 and I think it was 38 billion divided by 19,410, I'm going to get basically about 3.5% yield on free cash flow, which is not very good because you can buy a treasury and get that kind of free cash flow yield. In a treasury bill, a bond is almost zero risk. Carvana has risk. When you buy a stock, a company, Carvana could, again, trip up on themselves, buy inventory that's terrible, have losses, or stock price goes down, and then your yield gets worse. So this is an interesting case study of a company that really picked itself up. I am a fan, but I'm not an investor. Not enough return on my money. It's just not the right business. When we talk about businesses that I want to be an investor in, I want to be an investor in companies that are really, really, really strong businesses. So the company related to Carvana that I really love is Uber. And Uber, why do I like it? Is that Uber gets to control the network they've created. They don't have to buy any cars. They don't have to hire any drivers. The drivers come to them, and then they operate this network around the world for ride sharing. and it's profitable and it's generating great free cash flow and the stock's going, nice and high. The addressable market for Uber is massive and it keeps getting bigger. As we talk about robo-taxis, Uber's in a great spot for robo-taxis. So all those things I love about Uber. That's the next generation of transportation, is ride sharing, right? Now, Carvana I'm not going to put them in the red. I'm going to put Carvana in the gray, saying, hey, I tip my hat to other employees who worked really hard to get this company back on track. But it's just not the right investment for me. I'd rather find companies like Uber that are in the green, that have really clear differentiation, that really have really good barriers. I'd rather put my capital there it's going to double, triple very quickly, as opposed to Carvana, which is a great story. I don't know that they're going to go up very much from here, but we'll see. I hope I'm wrong. I hope the kids just keep killing it, keep proving people wrong, including myself. All right. We're going to talk about THX, which I have no idea what it is. Make sure I have it right. THX. So THX, are we talking about Thor? And I think they're traded up in Canada. So Thor Explorations, together with its subsidiaries, operates a gold producer and explorer. Company also explores for silver deposits. Okay, cool. This is a gold miner. And first, I like telling you what I'm good at and what I'm not good at, what my zone of comfort and knowledge is and zones that are not. Gold is not in my zone. It's not something I've ever invested in. It's not something that makes sense to me. But I'm going to evaluate this company and give you kind of like, if anything, just observations that I have. All right. So this is a very small cap company, $170 million. In today's day and age, that's the micro cap. That's like tiny. But their revenue is 181. So you're buying it pretty much a dollar, the same market cap as sales, which is pretty impressive. PE is super low. Man, look at 4P, 1.7. Oh my God. Talk about ridiculous. Now, over the last 5 years, stock price has been going up and down. Overall return, 64% return on investors. Now that's not great, but it's not bad. It's not bad at all. That's more than 10% return per year compounded. So that's not bad. And at some points, you could have exited the stock and made really good money. All right, so we got that going. When we look at their financials and look at the revenue growth, the revenue has been going down. It looks like this is a newer business. They just started operating in 2021. They started with a very good year. And ever since then, they've been losing revenue. Maybe, I don't know if, and I don't follow gold, but have gold prices been rising and falling? How have their volumes been, going? Has this company been efficient in their operation? Those would be questions that I would ask. Now, what is interesting is that they look to be profitable. So that's good. And they generate free cash flow. So that's good. So this is a free cash flow producing company, tiny market cap. If this is and let's look at their debt. Debt is bad, very bad. Debt can drive a business bankrupt and can keep the business from growing. So let's take a look at total debt. So total debt isn't too bad, 27.48 million. And I just showed that they produce as much cash flow, free cash flow, as about that amount. So that's pretty decent. So I'm liking what I'm seeing. I'm liking free cash flow. I'm liking the balance sheet's healthy. I think if you can establish that this company is being operated well and you feel like there's good upside, I mean, this is a pretty good idea. The 1 year return, the stock's down. Okay. So it's probably set up to really rally at some point. Let me look at gold prices really quick. So oh man. Okay. So gold has been going up. It's been going up quite a bit. Holy smokes. So my question around this stock we're looking at is if the gold price of gold is going up, which is what we're seeing here, why is their revenue not going up? You're getting a better price on every ounce of gold you sell, but their revenue is going down. So that would have to be answered. Is it they had their operation stop for a while? Is their operation efficient? Those would be the questions I'd have to get my head around, be comfortable. I don't invest in gold. It's not an industry that I like. It's not an industry that I feel is going to be just hugely valuable. But those are my comments on THX. This could be worth a lot more. I just don't know. It's not in my wheelhouse. So hopefully you found that interesting. Thanks for bringing that up. All right. So I think we're rounding third, heading for home, to use an American analogy. I don't know if you wanted to look at SM. I don't know if SM means anything here. So SM Energy, these guys are up 7%. What do these guys do? Independent energy company. Okay. These guys have been rallying to some extent. What kind of energy do they do? Oil and gas production. So this has been kind of a mixed bag. I'm a Chevron stockholder, a pretty significant position. I own like 130,000 of Chevron stock. And I know the oil business quite a bit. It was one of my first jobs out of college. I was an accountant with an oil company. And, but these guys here, the oil complex has been going up and down based on oil prices. And more recently, oil has been going down, which I think you can see how the stock price is coming down. It's because oil prices have been coming down. There was a rally in oil prices, especially with the conflict in Israel, where there's tension between Israel and Iran, which could really cause high oil prices. High oil prices will drive up oil companies. It's a very simple equation. And in this case here, this company is tied to it. It's a $5 billion energy company. The revenue is 2.34. PE is really low. Wow, it's incredibly low. Now they have 2.3 billion in revenue. It has been coming down. It's principally because oil prices are coming down. You can see oil prices were really high a couple of years ago in 21. You can see that their revenues really grew. Probably as they produce barrels of oil, they could sell them at a higher price. So they had a nice peak here, but now they've seen their market really dissipate. Energy companies are, you have to buy them at the right time and then get out of them at the right time. They're not like long-term, value generators. Let's say like our friends at Microsoft, if you've held Microsoft for 20, 30 years, man, you're sitting pretty. It's not like that, where they just have gone up over time. Energy companies go up and down based on oil, and they don't keep a lot of that value. It's not like they just continue to get bigger and bigger and bigger decade after decade. So those are my comments on SM. All right, everybody. So thanks so much for tuning in. I really appreciate it. I appreciate everybody having a little bit of patience as I got my first session on stocks. Everybody who won some money, congratulations. I'm going to be doing more live streams on stocks, and I'm going to get better at it. So I appreciate everybody's patience as I got the first one out of the way. I promise the other ones I'll do a little better job of knowing what to do, especially around the raffle wheel, which I didn't even know I was going to have a raffle wheel on this live stream. So thanks for bearing with me. And check out, I'm going to publish this live stream on my YouTube channel. Feel free to take a peek at my YouTube channel if you'd like more content like what you saw. As you can see, I take kind of a deep dive into companies, and I really evaluate a lot of companies. So you can take a look at that if you find this content interesting. I want to thank the Stonks team. You guys are putting together something that's really interesting, a lot of fun, frankly. I attend the Stonks sessions, and I end up putting myself on mute sometimes when I'm co-hosting, I guess, is because I have a lot of fun. I end up laughing a lot because they do make it fun. And I think investing is freaking awesome. It's really fun to find companies make lots of money, but have fun along the way. So everybody, have a good night. Thanks again for tuning in. We'll see you on the next one.